Hi, it's Phil at Stopford's. Just doing a short video for you on a terminology of accounts words. I'm going to do a short series of videos running through accounts, what they look like, what it all means, how to generally interpret them, what looks good, what looks bad. But prior to that, I just want to do a quick video and what the words actually mean, so you'll understand when we do the other ones. Okay. First report of any significance that we've got is called a statement of income and retained earnings. Used to be called a profit and loss account because that's generally what it is. There's another profit and loss account which we call a detailed profit and loss account, which is the next slide, and this is essentially a summary of that down to here, profit before tax. The only thing that's different about this one is that this is the only place where you will see tax and dividends. Tax speaks for itself. Dividends are amounts payable on the shares of the company. So, for example, part of my pay, if you like, every month is based on the shares that I own in Stopford's. Similarly, if you've got shares in British Gas, British Telecom, National Grid, you might get shares dividend payment every 6 months based on the shares that you own, and it's exactly the same principle, except that many business owners take dividends monthly. Okay, so now I've got the detailed profit and loss account that I spoke about. Okay, this is this is all the interesting stuff really that I usually skip straight to. We've got sales, cost of sales, administrative expenses, down here profit before tax, which is the line where the previous report picked up. So we have sales, speaks for itself, then we have cost of sales, which is all the costs that are involved in bringing that product to market. So in this case we've got purchases in there, which would be purchase of materials. Quick example, car. So you've got purchase of bits, parts, and you've got wages of all your workshop operatives, people, putting them all together. They put all those bits together, turn them into your saleable product. So the cost of sales is everything that's involved in creating that product or car in that example. It's basic, because there'll be other things involved in a car, but that's generally what we're trying to achieve here. Well, in here you'll also see opening stock, which is what you had on the shelf at the start of the year, and we've got closing stock, which are the bits that I had on the shelf at the end of the year. All those things combined to give us total cost of sales. So what we want is a figure of what it cost to bring those units to market. So I've got the sale value less the cost value just for those units. So if we've got 10 cars up there, what we want in here is the cost for those 10 cars, which is why closing stock is taken off, because nothing's happened to them. Gross profit is that money that we've just made on those 10 cars, if you like, and it's also expressed as a percentage, and the 70% is really good. Depending on the industry, it could be anywhere between 20 and 50. Niche markets might have a higher one. Companies that are dependent on volume, it will be a smaller margin because they're dependent on a bit higher volume of sales, and that's how they make the money. Okay, next line down, admin expenses, often called overheads. These are all the other costs that are associated with that company that you can't do without. So we've got directors' remuneration, directors' salaries, can't do without directors. Rent, light and heat, insurance, accountancy, bank charges, all these other things that the company needs to keep it going. They're not directly related to bringing products to market, which is what they call admin expenses or overheads. Then we've got operating profit, which is essentially profit before interest. Because just down here we've got interest received, and we would have had interest payable if there was any in this company. And after that, we've got profit before taxation, which is where the other report picked up. Okay, moving right along, balance sheet. Okay, starting from the top, intangible assets. Intangible assets you can't touch. Tangible assets you can touch. Current assets, creditors, provisions, capital and reserves. Okay, fixed assets, intangibles, assets that you cannot touch. Trademarks, franchise purchases, brands, patents, licenses, goodwill. I've not got it on that list, but that's usually, quite a common one. Franchise purchases is maybe classic ones, McDonald's, you know, a name that you buy to trade under that name. It's not something that you can touch, but you bought that asset to trade with. Tangible assets that you can touch: tables, chairs, computers, buildings. Okay, current assets. These are assets, things that can be turned quickly into cash. So we've got the obvious one, which is cash. We've then got stock and work in progress. Stock, products you've got sat on the shelf ready to go. Work in progress will be things that are already part made and that you can sell pretty rapidly to turn them into cash. Debtors are usually broken down in a note to the accounts. We've got customer balances, people that owe you money. We've got other debtors, maybe a staff loan, somebody that you've companies lent some money to get them through something. We've then got prepayments and accrued income. Prepayments, classic example is insurance. You might buy your insurance policy for a car, you know, your combined liability policy halfway through the year, which means that 6 months relates to the year that we're in, and 6 months relates to the year after. So a prepayment is the way that we move 6 months into the next year. Accrued income is maybe a sale that a company's made or contracted to make, but it's not actually invoiced until the year after. Main example would be a construction contract, something that's ongoing. You know, a big project that no invoices have been raised for a year or so, but nevertheless the company's done quite a lot of work to it, so it has some value. Okay. Liabilities, debts that are owed. Current liabilities, debts that are owed immediately or within 12 months. Suppliers, VAT, POE, corporation tax, an element of loans and HP. All these things are due now or within weeks or months, or definitely within 12 months. Again, just referring to the note in the accounts, you'll have bank loans, trade creditors, corporation tax, other taxation security, which is an overall heading for VAT and PAYE. Bank loans, the way these are treated in the accounts, they're split into two elements. You've got an amount due within 12 months, and you've got everything that's due after that point. The amount due within 12 months will sit here within creditors, current liabilities. The rest of it will sit in creditors due after 1 year, which is what we've got here, which are long-term debts. So we've got bank loans due after 12 months, same thing, hire purchase. Things that you buy a car or a building, get a mortgage, it's a long-term thing. So you will have an element that's due within 12 months and the rest of it is due after. These are long-standing accounting rules which we follow. That's the way that we have to split them up. Okay. Provisions for liabilities, deferred tax essentially. I've talked about this in one of my earlier videos. Deferred tax is based on asset values versus tax asset values. It's not a tax that's paid, so it doesn't sit within current liabilities. It sits on its own in provisions for liabilities because it's not due. Okay. Finally, we have capital and reserves. In there, we've got two headings. We've got call-up share capital, and we've got profit and loss reserves. Share capital Usually, it can be changed, but usually when the company is set up, it'll be set up with, in this example, maybe 1,000 shares for the people, and this is how the company's owned. So I might have 500 shares. My co-director Glenn have 500 shares, and between us, we own the company. So we've got 1,000 shares of £1 each. Profit and loss reserve. This is an accumulation of profits and losses from day one, from the first day the company started trading. If the company makes a profit for the year, it goes up. If it makes a loss, it goes down. And that total equity, previously called shareholders' funds, is all due to the shareholders. That's their money. Whoever owns a company owns all those reserves. Okay, I think that's it. So in my next slide, my next videos, we'll run through what some of the figures mean, and I'll try and help you understand what accounts actually mean. Thank you.